the U.S. stock market is currently experiencing significant turbulence. It's volatile, unpredictable, and appears to be reeling from recent policy shocks. Interestingly, across the Atlantic, European markets are demonstrating remarkable resilience, even outperforming both Wall Street and the Chinese markets. This divergence is quite surprising, especially considering the deep interconnectedness of these two major economies, with approximately 25% of European stock assets having ties to the U.S. So, from an American perspective, the question is, why is Europe thriving while America seems to be stumbling? Let's break it down. 1. Trumponomics, a tale of chaos versus stability. At the core of the instability plaguing the U.S. market lies the trade policy spearheaded by the Trump administration, particularly its penchant for tariffs. Financial markets inherently dislike uncertainty, and President Trump's abrupt and shifting tariffs, levied on allies like Canada, Mexico, and now Europe, have made any form of long-term planning incredibly challenging. One week we're facing a potential trade war, and the next, it's seemingly put on hold. The most recent escalation involves a significant 25% tariff imposed on European steel, aluminum, and automobiles. Why Europe is winning in this scenario? Predictability. The European Union doesn't operate under a policy framework dictated by social media posts. Its trade regulations are generally stable and well-defined, which is positioning European stocks as a safe haven for investors seeking to escape the volatility
it's
emanating
American
from the
tech and
U.S.
finance giants
Leverage.
that dominate
The EU
Europe,
acts as a
not
unified
because they
bloc
have
when
to,
it comes to
but
trade
because Europe
negotiations
allows
and
it.
disputes.
Push too far, and
This
Brussels
gives
has
it considerable
options,
leverage.
imposing digital
If
taxes
the
on
U.S.
Silicon
pushes
Valley,
too aggressively,
tightening financial
Brussels has
rules
the
on Wall
capacity
Street,
to
and
retaliate with
delay or
measures such as
blocking
digital
mergers
taxes targeting
involving U.S.
Silicon Valley
firms.
giants,
And if it
stricter
really
financial
escalates,
regulations
the
on
EU
Wall
can
Street
unleash its
firms,
trade
or even the
bazooka,
potential
the
blocking of U.S.
anti-coercion
tech mergers.
instrument. That could mean
Furthermore,
banning
the
Musk's
EU's
X,
newly
blocking
implemented
U.S. tech
anti-coercion
investments,
instrument
or
could
even
escalate
withdrawing
matters
IP
significantly,
protections,
potentially
allowing
leading to the
European
banning of
companies
U.S.
to
tech
use
platforms,
U.S. patented
like
tech
Elon Musk's
and
X,
software
the revocation of
freely. And that
intellectual
brings us to
property
the second
protections,
pillar of
or even the
Trumponomics,
freezing of
the
U.S.
growing
investments
threats of a
within the
recession.
EU.
Are you expecting a
2.
recession
The
this
growing
year?
threat of a U.S. recession. Even
I
some of
hate to
President
predict
Trump's
things like
allies are
that.
acknowledging the
There
potential
is
for
a
short-term
period of
economic pain
transition
resulting from his
because what we're
policies.
doing is very big.
Goldman
We're bringing
Sachs,
wealth back
for
to
instance,
America.
has recently
That's a
lowered
big
its
thing.
2025
There's absolutely going to be
GDP
short-term
growth
pain. The president's
forecast
been
for the
clear about
U.S. from
that. Everyone has. I mean, if you're
2.4%
going to
to a more
remodel your
modest
house to make it better in the
1.5%,
end,
and has
it's going to be
increased the
really annoying in the
probability
short
of a
term when your
U.S.
house is getting
recession to
remodeled.
35%.
And markets are taking notice.
Interestingly, prediction markets now indicate a nearly 50% chance of a U.S. recession, a significant jump from the 20% probability seen under the Biden administration. Why Europe is winning in this scenario? While the U.S. economy is grappling with significant uncertainty, the European economy is demonstrating a degree of steadiness. There isn't a dramatic boom occurring, but equally, there isn't a looming crash on the horizon. The strengthening euro, while potentially a headwind for EU exports, actually signals investor confidence in the stability of the European economy, a level of confidence that the US dollar appears to be losing under President Trump's stated preference for a weaker dollar. 3. Debt and the 5D chess conspiracy theory. Here's a rather unconventional theory that's been circulating. Could President Trump be intentionally trying to weaken the US markets as a strategy to manage the nation's massive debt? The United States currently owes a staggering $35 trillion, an amount so vast it's equivalent to the cost of building 24,000 Burj Khalifas. The annual interest payments on this debt alone amount to a staggering $1 trillion, which is comparable to the cost of building 666 Burj Khalifas every single year. The logic behind this theory is that a weaker economy could potentially compel the Federal Reserve to cut interest rates, thereby making the refinancing
Look at
of
the
U.S.
numbers.
debt less expensive.
U.S. national debt
A
is over
reality check.
$35
It's far more
trillion.
likely that President
To
Trump
put that
is
into
simply acting
perspective,
in line
you
with his
could build
established approach,
24,000
utilizing
Burj
tariffs as a
Khalifas
rather
with that kind
blunt
of money.
instrument rather
Picture
than as
that
part
on
of
the
some
U.S.
grand,
skyline.
intricate
But it gets
strategy.
worse. The interest
However,
alone on the
regardless
debt
of the intent,
costs
the
about
negative
$1 trillion
impact on U.S.
per year.
markets
That's
appears
the
to be very
equivalent of
real.
building
4.
666
Europe's spending
Burj
boom in
Khalifas
defense and
every single
technology.
year, just in
While the
interest
United States
payments.
is navigating
Even
a
for the
period of
US,
political and
that's a
economic
lot of
dysfunction,
money.
Europe
So what
is
would help
engaging in
reduce the
significant
repayment
investment in
rate?
key sectors.
Well, lower interest
An
rates
$800
would, and
billion
a weaker US
loosening of
economy
fiscal
often
rules is
leads to
underway,
exactly
which is
that.
expected
If
to
the
fuel
markets
investments
tank
in
and grow
infrastructure and defense capabilities across the continent. Germany alone is committing a substantial €500 billion to bolster its infrastructure and another €500 billion towards strengthening its defense sector, a development that is proving to be a significant boost for European defense stocks. European artificial intelligence startups collectively raised a record $11 billion in funding in 2024, marking a substantial 52% increase. Companies like France's Mistral and the UK's Wave Tech are gaining considerable traction and recognition in the global AI landscape. The catch: Europe's inherent weaknesses. It's important to acknowledge that Europe isn't without its challenges. The continent still grapples with overregulation, exemplified by policies like GDPR and the AI Act, which some argue can stifle innovation and slow down technological advancement. A more risk-averse investment culture compared to the US, with only 10 to 30% of Europeans typically investing in stocks, compared to approximately 60% in the United States, where equity ownership is more prevalent. A lack of European tech giants that can truly rival the scale and influence of American behemoths like Apple or Google. Bottom line, is this a golden opportunity for Europe? For the first time in many years, Europe finds itself in a position where it has a genuine opportunity to outperform the US stock market. However, to sustain this momentum, certain crucial steps need to be taken. Reducing bureaucratic red tape without compromising the stability and regulatory frameworks that are currently attracting investors. Actively encouraging investment in equity markets rather than the traditional European preference for savings in bonds and real estate. Focusing on building its own robust tech future, rather than solely concentrating on regulating the sector. At this moment, Europe stands as a beacon of relative calm amidst the global economic storm, and investors are clearly taking notice. Whether this period of outperformance proves to be sustainable will largely depend on the EU's ability to seize this unique moment and adapt, rather than reverting to its more traditional patterns. What are your thoughts on this situation? We encourage you to share your comments below, subscribe to our channel for more in-depth analysis, and don't forget to hit the like button if you found this breakdown insightful. Thank you for watching.